Good afternoon, everyone. My name is Michael Naidrich, and I am the co-CEO of AmeriVet Securities. As always, I am joined by my partner, all things Fed, rates, and liquidity, CFA Gregory Faranello. How are you, Gregory?
Good. Good afternoon, Michael. How are you?
I'm excited. It's our last one of the year, which is hard to believe. As you know, Stevie and I have been on the road for 8 weeks, so there's been a lot of chatter about rates and what's going to look like moving forward. So we got a lot to get into. We're going to do it just me and you today since we have a pretty big slate here to tackle. And let's just go right on. I know everyone's saying a quarter maybe or like 85%, 90% locked in for the next meeting. Tell us what you think for 24, 25, maybe even 26 at this point.
I don't know that we're that good for 2026, but yeah, look, I mean, we're largely priced for 25. Our thought to start this year was recalibration of roughly 100 basis points. It looks like we'll get there. So, for this week, obviously it's going to be about Powell's presser, but it's also going to be about their new summary of economic projections. So how they look at 2025, 2026 into 27, and then their long run estimate of where they see that neutral rate, not too hot, not too cold. So what we think will probably happen is, the Fed will lift in 25 and 26. So there'll be a little bit less there in terms of rate cuts. They'll probably spread things out a little bit over the next couple of years. And then they may even raise their long-term neutral estimate, which is now at 2.9. They could raise that to 3, maybe a little above 3, which definitely seems to be market consensus. So I think that's where things are going to focus. And then with Powell's presser too, in November, he was asked about the election and he kind of deferred there, but it was fresh. Now we're getting a better sense for how things may shape up. So my guess is in the press conference, he's asked a little bit further about what he thinks about the fiscal side and potentially how that could impact monetary policy going forward.
Understood. So, obviously with everything going on geopolitically, we've been extremely active with our white papers, with our generals, and actually having a fair amount of meetings off of that. But, you recently put out a very interesting, timely white paper on the tariffs. And, this is a very hot button issue. I think sort of Trump supporters are says he used it as a negotiating, point. Others are saying it's a cost to living for, everyday Americans. And, Trump is out there pipering that he's going to make America rich again. So, if you can go into it a little bit for those who have not seen the white paper yet, that'd be very helpful.
So what we tried to do is provide a little context in terms of, ultimately what tariffs mean from a revenue perspective. And when you look at those numbers relative to what the government generates in terms of income, it actually equates to a very small portion of what we take in to fund the whole federal government. If you listen to the CBO and they project out, 2025 to 2033, they have an estimate of what tariffs could bring in based on where they are now. And obviously they're subject to increase. But, relatively speaking, it's a small amount of income. Now, I can't speak for the president, but where tariffs have really gone as of late, and we look back to the first Trump administration, they have become a tool for negotiating. And I think if you look at the position economically right now of the United States, certainly relative to Canada, Mexico, certainly China, which has been very weak, and Europe as well, we do seem in a very strong position based on how the consumer has behaved, based on how our economy has behaved to potentially renegotiate things over time. So we suspect that's where it heads to. With regard to inflation, it's a little less clear. Like if you go back to look at the inflation numbers during Trump 1.0, inflation wasn't even running at the Fed's target. So these tariffs actually didn't wind up being inflationary at all. The one thing I would say, and the one argument you can make, are that the inflationary numbers of late, the core numbers, have been running 0.3 month over month, 4 months in a row. And the first quarter of 23-24 have been sticky months in terms of these monthly inflation readings. And in 2024, it actually threw the Fed off course with the market pricing in all these rate cuts, and then we price them out and then price them back in. So to me, it's unclear how it works in terms from an inflationary perspective. Certainly it's a tax, but you've got China right out of the get-go saying here, that we're going to weaken the yuan, right? So they can toy around with their currency a little bit. And that's part of the reason I think tariffs come into play over time. But I think it's unclear. It could shake out a number of different ways. I would caution, though, the one difference this time around is that we are coming out of a very big inflationary pocket. And psychologically, that could certainly play in.
Yeah, it's a little bit
Does,
of a different time than it was when Trump 1.0
does
for
that make
sure.
sense? It makes sense
Yeah,
a
yeah,
little
it
bit,
makes a
right?
lot of sense. Yeah, 100%. So let's get out Greggy's crystal ball here. Let's look a little bit beyond, the end of the year here in 2024. Let's talk about President Trump. Let's talk about, sort of what the fiscal policy looks like and how the Fed sort of interacts with all that.
So it's a good one. If you go back to, certainly change is coming. I mean, I think that much is clear. We don't know exactly what the changes are going to be, and that's part of the challenge for the Fed. Chair Powell in November saying we don't guess or assume, but the reality is we can't sit around and not guess and assume for very long because the Fed is going to fall behind the curve. So, when all is said and done, I do think the Fed needs to start factoring in some of these potential changes. On the regulatory side and on the technologically side, it's unclear. I mean, productivity is up, which is good. If productivity continues to stay high and increase, we do think it will give the Fed room to probably come down a little bit further here. But my sense, even before the election, was gradualism, a little bit of caution here. I think you'll hear that from Powell, no preset course. And I think it's smart, right? It's smart for the Fed to intimate rates to continue to come down. The pathway will still be lower. We're calling it slower and lower
Yeah.
is what we're coining it. Being a little bit more cautious, seeing how some of the fiscal stuff plays out. We've already got a lot of fiscal stuff in the pipeline, by the way, coming out of the prior administration. So in my view, this could only add a little fuel to the fire. We don't want to see inflation start to reaccelerate. And the last thing these markets will need is for the Fed to have to U-turn and go back the other way.
Yeah, I understand and agree. So let's talk about it. On the road a lot, seeing a lot of different clients in a lot of different sectors. And, the geopolitical situation remains tenuous at best, right? I mean, we still have three or four major conflicts, and that doesn't include what we don't see, which, is always out there. The U.S. has been, really a capital haven, during this time period. I think we just saw today, maybe it was late last night, SoftBank is committing $100 billion. What does it all mean? Break it down for us.
So that's a good question. It's probably the most relevant point I think that we're looking at right now. Where does the capital flow? The president-elect is saying we want your capital here, and that was one of, I think, many announcements that could come. The ultimate outcome of this, really short term, has been strengthen the dollar. That's where we've seen it. That's where we've seen this notion of American exceptionalism and capital flowing into the country. I think we want to be a little careful because we do have a lot of dollar exposure abroad and a lot of securities in a lot of other countries. So we want a strong currency, but we don't want the currency to appreciate too much in the process. But, look, certainly China's been weak. They've been easing dramatically to try and support their markets. So we've been the beneficiary of that. Europe is very weak. They've been easing policy. So you have the economic differentials, you have the interest rate differentials, you have the economic differentials. At the end of the day, the dollar just doesn't move because what's going on here, it's also a function of what's going on abroad. So there's no reason to believe that those capital flows aren't going to continue. Our interest rates have come down, but they can stay a little bit more relatively high versus some of our counterparts. Canada eased 50 basis points.
Yep.
The Swiss National Bank eased 50. So the Fed is going to have to take these things into consideration. I mean, it's America first is the policy, but we can't operate in complete isolation, if that
Yeah,
makes
it's
sense.
not America only. It's America
It's
first.
not
And I think you're
America
right.
only. Right.
Yeah, it's a good point. So maybe we can stay on Europe for a second because, there's always so much talk about China. Europe's really struggling. I mean, what's it going to take for Europe to move forward and I love our people over in Europe, but to get out of its own way and get moving in the right direction here.
Yeah, it's tough. I mean, look, the euro for a long time has been has been a tough concept to grasp, and they've certainly had issues. I wouldn't necessarily say these issues are akin to what we saw, back in 2011 or 2012. But the peripheral spreads, when you look at not just Germany, when you look at the other countries, we have seen some widening there. It is an interest rate story a little bit now, but it's really a fiscal story, and it's not just France. I mean, we've seen the issues in France. We're seeing the issues in Germany. We see the issues a little bit in Italy. There is a sense of populism around the world right now. And, I think for the US, we kind of worked through that process. We'll continue to work through it in 2025. But I think a lot of countries are looking to us for leadership right now. And I think that's been the short-term takeaway from my perspective that we've seen since the election in November. But I think in a nutshell, Mike, it's going to take time is what it comes down to. And reforms.
And we don't live in a patient world anymore. So it's very interesting to see how that will work. I guess just a couple more points here as we wrap up 2024. We got the Fed easing, but Treasury rates are moving higher. So it's sort of been counterintuitive, right? So what do you make of all that?
The Treasury market is saying the Fed shouldn't be doing anything right now. Right. I mean, that's
you hear that a lot. You hear that a lot.
You hear that a lot. I mean, we started writing a couple of months ago. It's counterintuitive, but if the Fed just did nothing, rates would probably come down from here, would be my guess. Look, in the end, inflation is the underpinnings of fixed income investing, no matter how you look at it. So in 2022, we had an inflation problem. The Fed came in and solved it. All rates went higher. But really, since then, fixed income has done pretty good because the market perceived the Fed to have their inflation fighting tools on. Now, I think the market's looking at, nominal growth. It's looking at inflation. It's certainly looking at the new administration coming in. And at the same time, they're seeing the Fed ease and they're saying, okay, wait a second here. Maybe you shouldn't be doing anything. That's part of it. The other thing, too, is, we call it the bond market reaction function. So take last week, we had Treasury supply. We had to bring all this Treasury supply within this pocket of time. Term premium went up, and that's, it's a term premium shock short term. So we are seeing a little bit of that price action in terms of bond market function reaction when we get this Treasury issuance in the marketplace, the market repricing to take down that supply. And at the same time now too, Mike, as you and I know, I mean, balance sheet and risk appetite is not particularly high. But look, I mean, we're still well within the ranges of the last couple of years. If you look at the long end, we've been at 350, we've been at 5%, we're at 440 right now. I think portfolios will look to add selectively, duration where they see fit, not just in treasuries, but also mortgages and credit. And but there are no magical levels here. I mean, we could certainly move higher in yield for sure.
Yeah. So let's close with this, and maybe it's just a little bit of a vision for 2025. I think the environment has people excited. I think people think there's going to be a lot of M&A next year. I think people are thinking that the IPO market is going to be the most robust it's been since 2021. It's been 3 pretty lean years in that market, and you're starting to see a lot of S1s come, with the hope of the first quarter. I think people believe, the bond market after a very busy year in the IG will be up another 5 to 10%. What do you see going into 2025?
Yeah, look, I agree. I think the markets are going to be robust. They're certainly going to be wide open. In terms of issuance, I mean, issuers have not been afraid to come at these yield levels. I mean, spreads are still very tight. Mortgages have widened out, and that's a different conversation. But certainly issuers have not been afraid of these yield levels last year, and I think that'll be the case this year too. In terms of the overall market environment, I mean, look, risk assets have done extremely well. We could hit a hiccup in the first quarter. I mean, if inflation is a little sticky and we start to have to price out a little bit of what we have priced in now in terms of rate cuts, perhaps. But I think the landscape is going to be very, very constructive. It doesn't mean we won't have bumps along the way, but I think things look pretty good heading into next year.
Do you see the FTC lightening up a little bit under the new administration?
Yeah, 100%. I mean, these things will take time. The one thing I will say is, we have a president-elect that's been acting as if he were the president now for a month to 2 months, right? So he's he's way ahead of the curve because, it's not really a new administration, but it is in terms of personnel. So I think there's a game plan in place, whether you agree with it or not. It seems to me like things are moving pretty quick. And it also seems to me like people are willing to jump on board pretty quick too on the corporate
Yeah,
side.
I do think leaving politics out of it, 2.0 has a much better understanding of what he's walking into than 1.0 of Trump. And, like you said, agree or disagree with the vision of it all, I think it's going to be very direct and hit the ground running. So, Greggy, here we are again, the end of the year. Extremely grateful for your insights always. Appreciate how hard you dig in always. I know our clients have really responded to you. We'll continue to take client calls, starting really, I mean, we don't stop. So if they wanted one tomorrow, we probably get on the call. Looking forward to seeing you Christmas Eve on one of the cable networks. So thank you for doing that. And just, I'm looking forward to our guests next year. But I think with today, we wanted to keep it just me and you because there's a lot to go over here to the tail end. So let's wish happy holidays to all of our friends and clients. Wish everyone continued safety in a dangerous world, and just looking forward to getting back at it next year.
Thanks, Mike.
Thank you.